Right then, good afternoon, folks, and just another update from us on the goings on across financial markets this week. We'll start with the calendar. As always, we'll have a quick flick across the calendar and then we'll jump into some charts and see what we are looking at on quite a busy week in relation to the economic calendar. On Monday, GDP figures out of the UK. Month over month figure we get a month over month figure in terms of the GDP prints rather than the quarter over quarter figures in a lot of the other countries. But uh, consensus 0.4, as you can see, actual 0.5. Reason why I think that personally is a bit significant is that the central bank, the Bank of England, did suggest that we were going to see a recession in Q4 of this year, over obviously then Q4 being October, November, December, and that is then month one. That is the October figures, right? As the October GDP print from the UK, and that is positive. Obviously, you need two consecutive quarters of negative growth, and if you can avoid a recession in Q4 of this year in the UK, well, then that's a slight positive. Definitely seen as a slight positive going forward for the economy, meaning that the recession is not as long and as drawn out as some market participants may have first feared. But apart from that, then we'll jump on to a couple of other more important things as we get on through the rest of this week. The CPI print, the CPI out of the US on at 1:30 on Tuesday. Consensus was for 6.1 in the core CPI print. Actual came in 6% here, as you can see. The total rate of inflation, once you include food and energy, 7.1 over a consensus of 7.3, right? So inflation across the board dropping, whatever metric you choose to look at it on, whether you include food and energy or you remove food and energy, well, then it's still pushing lower across the board. So that's obviously a positive thing, and markets took that as a positive. The stock markets were up massively off that. S&P was up 120 handles in the space of 90 seconds, and then had a pull back towards the lows, and then has kind of accelerated then lower after we had the Fed not yesterday. I was going to say yesterday was the Bank of England, the ECB yesterday. Brings us on to the Fed then. Brings us on to the Fed and their updated economic projections. 50 basis point hike widely expected by markets. That's not really a surprise. That's not a surprise at all. That's what we were expecting. That's what they had communicated to markets. But what we were looking for is maybe more of a clear idea on where the terminal rate for the federal funds rate would actually end up being. We got the dot plot upgraded economic projections. Mainly, the dot plot was the kind of main thing people were looking at when it comes to those economic projections. 5.1% was the expected terminal rate. So that would imply then another two hikes of 25 basis points, probably in February of March of this year, of next year, and then the bank will likely go on hold then, and then see how that plays out. So personally, is it necessary? Is another 50 basis points necessary? I mean, inflation is pulling back. Obviously, we'll need to see the January print when it comes to inflation, but is it a case of? I mean, they started hiking rates too late. They started hiking rates too late. They stopped kind of printing money, to use an easy term, a little bit too late. And are they now hiking beyond what they have to hike and stop? Are they stopping hiking rates a little bit too late? I mean, it's a bit like an amateur boat captain. It's like if you've gone to turn the ship, you haven't turned the ship until a little bit too late, and then once you've started turning, you then turn too far too fast, and it's a similar sort of scenario. I mean, if inflation is pulling back and they are getting that under control, I'll say under control, it's still far too high, but it is still pulling back at the moment. You've had 4 or 5 months of consecutive lower prints in the total rate of inflation. You've had now two consecutive lower prints in the core CPI print. So if these rate hikes are beginning to take effect and starting to do their job correctly, is it necessary to continue hiking? Well, personally, I think they should be going on pause now, to be honest with you. But again, what do I know? I'm not the chairman of the Fed, unfortunately. But that's just my opinion when it comes to the Fed. But only time will tell. We'll have to see then, do they end up hiking the economy into a recession? That is definitely a possibility. Apart from that, then on to Thursday. On the Thursday, with the Bank of England and the ECB yesterday, a raft of central banks out this week. When it comes across to the Bank of England yesterday, a 50 basis point hike, also a 50 basis point hike from the ECB. And the Bank of England did give us kind of upgraded projections as well, upgraded their thoughts on inflation, upgraded their thoughts on growth. They think the peak in inflation is in. You can see this CPI print from out of the UK on Wednesday. Still double digits. They're not double digits, so they say they do need to continue hiking. We have to expect more hikes in upcoming in the future, and that's 9 consecutive hikes at the moment. We are expecting that to continue. We'll probably get into double-digit figures for consecutive meetings where they introduce a rate hike. So now the interest rate's back up at 3.5%. Obviously, to get a grip on inflation. Inflation is still double digits, so they still have a way to go in terms of the need to continue hiking interest rates. The ECB is a similar picture. All the central banks are a similar picture. They still continue to hike interest rates, still continue to still continue to say that the labour market is strong, so they can afford to continue to hike rates. A lot of the central banks are seemingly accepting the fact that there are going to be recessions across the board in many of their respective economies. So the ECB interest rate back up at 2.5%. With inflation where it's at, inflation print out of Europe of double digits over the course of this week. And they've got an interest rate at 2.5%. They need to continue hiking interest rates. They have to continue hiking interest rates, and sorry, they need to continue hiking interest rates. They have to continue hiking interest rates, and that is likely to be a theme going forward for the ECB. They did announce a plan to reduce their balance sheet, to reduce the balance sheet, which is a hawkish step by 15 billion. 15 billion a month in terms of reducement of the balance sheet. That is obviously a hawkish step, right? It's a hawkish step that is done to remove support for the economy, remove money from the economy, and hopefully then slow down the pace of inflation. So a couple of things. Now, maybe the Bank of England, you had a couple of 6 of the 3 members voted for the 50 basis point hike. 2 wanted less than that. 1 wanted a 75 basis point hike. That's all sort of more of a dovish tilt to the Bank of England, a bit more of a hawkish tilt to the ECB. And then the fact that we're going to see 5% interest rates, market have not 5% interest rates in America. The markets have not taken too kindly for that, and the S&P is then sold off. We'll jump back to the markets and just have a quick look. The dollar index, right, the US dollar, grinding lower at the minute, still grinding lower, not moving lower with any sort of aggressive pace, but we are still moving lower. I think the important thing even after the week inflation print, we did bounce pretty aggressively. We have bounced pretty aggressively off this trend line, as you can see. Little bit of a head and shoulders, bit of a left shoulder and a head and then a right shoulder. Kind of action there. Not perfect. Double top kind of head and shoulders. That sort of vibe. Not very clean. But we have rejected off the trend line. We have pushed down lower through the support level at 3,900, and then next target and to the downside. Certainly from a charts perspective, would probably look towards 3,700. But does this provide a better opportunity to get back in? I mean, the Fed, whatever way you try and spin it, the Fed are slowing down the pace of hikes. They are approaching the end of their hiking cycle, so that is an environment that stocks like. So is it worth trying to pick some stocks up over the course of next week at a bit of a discounted price, as we have sold off a bit since the Fed and inflation? Is it worth taking a bit of a punt on some long stocks? We'll have to see, but we are expecting a recession, and that is not an environment that stocks enjoy. So yeah, for now, charts look slightly bearish, but I probably would keep in mind that maybe it's worth taking a punt back at some longs. Yields relatively subdued. The yields not doing much. Yields kind of chopping sideways throughout the course of the week. So bonds not really moved. Not had much of a reaction to the release itself towards the interest rate decision and inflation as well. So not a great deal to go off when looking at the bonds. 3.5% is the yield on the 10-year. where that goes in the coming weeks will give us an indication as to where we can trade the dollar and where we can trade the S&P 500 as well. Bit of a dovish response to the Bank of England yesterday. You can see the down day on cable, as you can see, most recent candlestick yesterday. Not a great deal of movement today, but a pretty aggressive sell-off yesterday off the back of the Bank of England as well. Markets did not take very kindly to it. Not much out from the bank. I'll say they're going to continue hiking rates with a recession expected. The higher rates have to go in order to cool down inflation. The worse this recession is going to be in the upcoming year. So definitely one to keep an eye on as well as we come across into next year. Not much to do with euro. Euro pretty balanced. The DAX is sold off as well. DAX is sold off, bonds sold off, yields higher. That's pretty expected reaction, but not a great deal on euro dollar, but a little bit to work with on the DAX if you were trading the DAX as of yesterday. So a raft of data out this week, a raft of different things to talk about in terms of movement on the charts. Unless you're short stocks, not fantastic moves really off the back of this. So maybe markets need a little bit more time to digest. Markets will be slowing down as we head into the Christmas week next week. So a couple of things to keep an eye on in terms of active trades, unless you're involved in CPI and short stocks back end of this week. Rest of the year might be slightly difficult to pick from when it comes to looking at opportunities. We'll come into next week, have a quick look at next week's calendar as we come into Christmas. Not a great deal out on the calendar next week. Bank of Japan, the BOJ, next Tuesday at 3 o'clock. Never get much out of them. CPI out of Canada, maybe worth having a look at, see what we can find. Inflation out of Japan, 3.7%. We're expecting that to rise further. So maybe we get some action out of the Bank of Japan. Never really do, but if you think about it, if inflation continues to rise and they do have to do something to alter monetary policy to get that under control, that will be a big step from the Bank of Japan, and that will provide good trading opportunities if we can get it. Apart from that, we'll be into Christmas next week. Christmas Day next Sunday, so Christmas week markets might be slightly slow, maybe slightly difficult to trade, but we'll obviously have to cross that bridge when it comes to it. We'll shut up shop next Thursday. We'll be fully finished next Thursday here in the academy. So yeah, there will be no insights next Friday. It's the last one for this year, unfortunately. So that is it from me. That is it from us for 2022 in terms of the insights. Pretty good year trading on a personal level, which is nice. In terms of markets, stocks trending lower for the majority of the year. If we can get stocks trending back higher at some point next year, trading will become a heck of a lot easier. But for now, we've got to remain cautious as we head towards a number of recessions into next year. But we'll have to speak about next year when we get there. Well, that's it from me then, folks. Have a good Christmas. Do rest up. Do get some kind of relaxation and do switch off from markets if you can. Take a bit of a break after a long year of trading. But have a good Christmas. Have a good New Year. And we will speak to you when we speak to you. Have a good one.